Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Dennis Dick, and we have Joe Saluzzi on the line. He is a partner and co-founder of Themis Trading, keeping an eye on the HFT markets. Joe, how you doing this morning?
I'm doing great, Joel. How you guys doing?
We're doing good. Some pretty good action here in the S&P futures off that unemployment number here. So we're keeping an eye on that. 2,077 and a quarter all-time high. We hit 2,077. So let's get right into, we talk about the Flash Boys. Well, someone came out to bash the Flash Boys book, and Flash Boys not so fast. And Joe, I know you've read the book. You had your own comments and criticisms on it, and you came out with a nice blog. What good points does Mr. Kovac make, and maybe what are some of the things that he's overlooking?
Well, I think he's comparing a lot of what the benefits of electronic trading have done for the market, and kind of crediting them only for what high-frequency trading has done to it. These are separate items, right? Electronic trading, no one would argue, at least we wouldn't argue, that it's been a good thing. Electronic trading's been around for quite some time. We started our careers back at Instinet in the early 90s, which was one of the pioneers of electronic trading, so that's a good thing. But to basically say that spreads have collapsed due to high-frequency trading is really not genuine, because spreads really started going lower when decimalization happened and when electronic trading came through. So there's a lot of credit that he's putting towards HFT when it really should be going towards the market in general when it comes to electronic trading. But look, he's made some points. He got a little press there, which is interesting, and we're not going to defend Michael's book. That's Michael wrote the book Flash Boys. I'll defend my own book, Broken Markets, but Michael will deal with his book. But it's a debate, and he got himself inserted into it. Mr. Kovac did, and congratulations to him.
What are your thoughts here on his book, though, overall? So he does make those points, on the electronic trading, but you wrote a nice little post here on the Themis Trading blog, and you've got 6 or 7 other points too that you're pointing out. Where obviously, he's pointed out throughout this book all the flaws in Michael Lewis's book, but it looks like there was potential flaws here in Kovac's book as well.
Well, I mean, specifics, there was a lot of smaller specifics. I don't want to get into all of them now. Folks can read the blog itself. But, we would just take issue with some of the items where he's giving credit to some and not others. Like I said, I don't want to go back and forth with this guy and even give him more credit than what it's getting right now. But, look, if people are interested, they can read it. If we think that Michael's book really told the real story, and the story of how our market structure has changed, and sure, Brad and the IEX guys are the heroes of the book, and because that's the way Michael writes, right? He's a great author, and I think the problem with some of these guys like Kovac and others are they're trying to specifically say Michael Lewis missed this, Michael Lewis missed that. Well, Michael Lewis is an author. Okay, he's not a journalist that has to find every little item or an academic. He wrote a story. And it's a very good story, and it really hit home, which is why so many people are talking about it, because a lot of your listeners who trade know exactly what Michael Lewis was talking about when in his book, how a bid disappears when you try to hit it, how when you post a bid, someone runs ahead of you by a penny. And, that was one of Kovac's things, too, where he was saying, well, front-running, these guys are saying that there's front-running in the marketplace, and that's just not true. And he's getting a technical point there. But sure, there's no front-running if you don't have any customers. In other words, most of these high-frequency traders are prop traders, and they're not front-running a client of theirs. What they're front-running is institutional demand. They're deciphering where the demand and supply and demand is based on, obviously, their speed and their knowledge of the book and so on, and they're moving ahead of it. So is that front-running technically? No, of course not, because there's no customer involved. But it is something that most traders understand and really are upset with. And I find always interesting, Dennis and Joel, is that when you look at the comment section of a lot of these articles, and it's always the same thing. It's never anybody supporting the current model. It's always a bunch of traders like the guys who are listening, the folks that are listening to this saying, yeah, that happens to me all the time. This is ridiculous. This should be, someone should do something about it. Well, that's where we are right now.
I mean, the market structure has changed so much. Like, I started trading prop in 1999, and if I compare, the markets to where it was then to where it is today, it's just a completely different animal. I was saying before you came on the show, we were talking about the jobs number and how it's so dangerous to set any limit orders out there as a trader. If you were sitting in, a limit order out there ahead of the jobs number on a stock like Citigroup, you get picked off instantaneously. Like I can remember back in 1999, you could set some limit orders out there, and you could still get them out. You could cancel them before getting picked off because, especially on the New York stocks, because it took 6 or 7 seconds to get the fill. And now it's like if you set a limit order out there, you're picked off so fast, and the price just blows right through you. It's the speed that really, obviously, is critical there, and can make to less liquidity because the traders are worried about getting picked off.
Well, absolutely, and then you damned if you do, damned if you don't. Because if you try putting in, not when the market opens, you try putting in market orders. Good luck with that. We all know what happens to those things as they, navigate the fragmented maze of quote unquote liquidity. But I think one of the issues also, if you want to just go back to that book real quick, was Kovac had mentioned, if there was something bad going on, if somebody was really doing anything, nefarious, the SEC and FINRA would have caught them by now. Well, we would say, yeah, you know what? Based on the last 6 months, there's been a lot of cases being, there's a case against Athena, a case against Latour, a case against Panther. A lot of these HFT firms are now getting caught doing things like spoofing, placing bids and offers which are not real, and now finally the regulators are starting to catch up. But unfortunately, what's happened over these years is the regulators are going into a gunfight with a knife. They don't have the proper technology. They don't have the proper data to find out exactly what went on at what point. They're getting there. The CFTC now has more power under Dodd-Frank to go after these spoofers. The SEC still doesn't have the power to go after them, but we're finally getting a little bit more. But on the flip side, let's look at Apple this week. We still don't know exactly what happened, why Apple crashed, and lost about $35 billion in market cap in a matter of seconds. Why not? Why hasn't a regulator come out and give a post-mortem by now? You would think they would know.
Kovac goes on to claim that high-frequency traders cannot see your order coming. Now, I don't know if he read the first chapter of the book or not, but what's your comments on that?
Well, I think he's saying, listen, we see everything. Here's the technicality that everyone says. When the information is distributed from the exchanges, it's distributed at the exact same time. So if you were to build a system similar to, let's just say, the best high-frequency trading system, you too can see that order coming out exactly the same time. The problem is it's a matter of distribution versus consumption. So the order may be distributing at one point, but the consumption time is different based on the systems that you have. So if you haven't spent as much money on your colocation, if you haven't brought a private gateway to get the information quicker, if you haven't done all the things that the HFTs do, which are quite expensive, and for most reasonable traders are really not doable, well, then you are going to be slower. You are not going to see that order. So what he's getting through is another technicality, another way of saying, I'm not doing anything wrong. I'm just seeing it first because I built a better system than you. Technically, he's correct. Okay, but that's the problem with the market. That's the problem with a fragmented market that allows exchanges to continue to sell, to continue to be for profit and worry about their own bottom line at the expense of most of their investors at the benefit of a few.
Joe, how do you navigate these markets then? Because obviously you guys are out there, you're trading in these markets. You know that there's, you're maybe disadvantaged compared to some of these other high frequency traders. How do you approach your daily trades when you're going in there? How do you navigate around these high frequency traders?
Well, you don't play their game, that's for sure. You're never going to win the game of a high frequency. If you're going to try to battle a high frequency trader, you're going to lose. I can guarantee you that. So you play a different game. Right? You don't play the speed game. We're trading for institutions, so our job is to move large blocks in and out throughout the day. Not necessarily like the old days when you would actually get a block trade up, but you've got to move, say, 100,000 shares of a stock that trades 1 million shares average per day, 10% of the volume. You need to be careful what you do. You're not going to go into an algorithm that says, okay, I'm going to buy 10% of the volume today. I'm going to sit there, and I'm going to hope to get VWAP. Because if you do that, you're going to get picked off all day long. So you're going to be smarter than that. You're going to navigate these different systems. It's a lot of, believe it or not, it's a lot of manual work. Even though you're trading electronically, you have to be smart. You have to bounce around. You have to pick and choose. You have to customize the routes where you're going. You need to get rid of the routes that you think are toxic, that are giving you an adverse selection. It's a lot of labor involved, and it's a constant upkeep, because as soon as you find something wrong, you need to tweak it again. So it's pretty much hand-to-hand battle. You're battling all day long, and in the end of the day, our job, if we don't give a good execution to the clients, we don't have a client anymore. So, it's not like I've got a big firm where we've got investment banking and research and all that stuff. We don't. So, if we're not doing a good job, they're gone. And so hopefully, so far, we've been in business for 12 years. We must be doing something right.
What about your customers? Is this something they complain about? Is this something that they see out there and that they're complaining about these high frequency traders seeing their orders and getting in front of their orders, or is this something that's just they just don't concern themselves with, and that's why they come to you?
No, I think most sophisticated institutional investors, most investors understand there is a problem here. And the problem is how do you deal with it, right? It's a struggle. It's a constant struggle. But they do recognize it. They do see the problems. Some of them have different methods of doing it. Part of it is coming to us, and we'll help trade for them. But a lot of folks do see it. But then, like I said, it's an enormous struggle to identify where the issues are. There's been a lot more attention lately being paid to where their orders are being routed, which is good. People should know when they put an order out there, where's my order going? How did it get there? Which is even more important than where you got the execution. If you sent an order and it got sprayed out to 5 different destinations, how did it get there? Did it stop? Did it spend? Did they take time to show a little something to their buddy in a dark pool first? Did they, let's just say there's things like that going on. Well, you need to extract that out of your strategy. So from the institutional side, a lot of them are getting a lot more involved. They're looking at these best executions. There's new systems. There's new, I think Larry Tadd's coming up with something new where he's analyzing this stuff. This is good stuff. So people are paying a lot more attention. So if anything, the debate has gotten to a very sophisticated level where people are now really grinding down saying, I need a better execution. I don't want to leave those pennies on the table anymore and let the high-frequency traders pick them up. Those are my pennies. Those are my executions.
And it's not only the pennies sometimes. Like this is one, complaint that I have from our traders is that it's the fact that they miss executions altogether sometimes because of the pennies. So you're sitting out there bidding for a stock at $17.20, and there's a high-frequency trader stepping ahead of you at $17.21, and then it all of a sudden reverses and goes up to $17.30. Sometimes you miss fills there, so it actually can add up to more than pennies. Isn't that right, Joe?
Yeah, it's absolutely right, and that's one of the things that I've yet to see a study identify the opportunity cost of a lost trade, taking exactly what you're talking about. So, say you're the price setter, you're the liquidity provider who bid 17.20. Say the stock was 17.15, offered at 17.30, and people may say, "Oh, it's a 15-cent spread." Oh, it exists. Most stocks nowadays have stocks that spreads that wide. Anything outside the top 100. Say you go out there and you want to tighten the spread at 17.20, and someone looks on the sell side and says, "You know what? I'll sell you that stock at 17.20. That's a good price." They go to sell you the 1,000 shares that you're bidding for, and someone steps and gets a 17.20001 print and steps ahead of you because they internalize that flow at a market maker. Well, that's not that sub-penny price improvement may go to that, to that new buyer. I'm sorry, to the seller. But what did you get? You got nothing, like you're saying, Dennis, and then you end up having to pay up a dime because the market's going higher now. So you were disadvantaged, yet it's an opportunity cost that hasn't been measured, and it discourages real liquidity providers like yourself and like others who want to go out there and show some bids and tighten up the spread. So what do you do then? You end up running over to a dark pool. You're sitting there for a while, and there's other games going on. So it's extremely frustrating, and it's that opportunity cost that really hasn't been looked at.
Joe, a lot of people accuse Mr. Lewis of, doing this book in cahoots with the IEX, and which I don't really put any stock in. But my first question is, are you utilizing the IEX? Have you been observing the volume and the transactions? Is it starting to get some momentum going, or is it? I mean, I know when exchanges start, it's a real tough process. How they doing over there at the IEX?
We are one of their trading partners. I think we were one of their first trading partners. We think the fills there have been very good. And what here's one thing that people don't understand about IEX is that you're not going to automatically get a fill because it's not a lit exchange. First of all, at this point, it is an ATS, right? It is a dark pool, if you want to call it.
Could you explain that ATS?
Sure, it's an alternative trading system that currently doesn't have a protected quote. So you won't see them in the bid or the offer. You won't see an IEX quote today in the national best bidder offer. Everything is in a dark pool, essentially. So if you want to trade on IEX, typically what we would do is I'll post a bid or an offer on IEX, and I'll put a minimum size in there, and I'm looking for a larger print. I'm looking for something bigger than the average trade size, which even in dark pools is still less than 200 shares. And what we've seen so far is that we are getting much bigger fills and better fills when we do get them in IEX than we do on some of these other dark pools, which have a lot of different players going through there. But what to say is that you're not guaranteed anything. But I could be sitting on IEX and getting nothing done when then I have to start buying some stocks, or then I'll go over to a lit exchange. So you can't just stay in one spot and say, oh, I'm going to get it all done on IEX. It's not going to work that way. But when you use that as a tool of your trading during the day, it has helped dramatically. I mean, some of these stocks I trade a lot of small and mid caps, and a lot of times there's nothing going on. If you're going out there, you're going to just try to take the stock, you'll get 1,000 shares, and you could have run it up 20 cents. Where if you've got some patience, and depending on your client, if they've got patience to work the order, you can get some fills in IEX. There's no guarantee, but it's just like any other, larger dark pool. There's another system called bids, which is pretty good. There's level. There's liquid net for the buy side, but it's a matter of strategy. So what they've done is gotten rid of, we think, a lot of the noise that you see in some of the other dark pools, which is some of the where you may get some of these adverse selections or some of the people looking to pick you off and so on. So overall, I think they've grown actually dramatically since they started. They're already up to 1% market share now, which is pretty good for a dark pool, 1% of the entire market. So I think they're moving quite, and their strategy now is to go to an exchange status. So
Right.
they're going to be moving forward over the next year or so.
Okay, Joe Saluzzi, partner and co-founder of Themis Trading. He's joined us a couple different times on the show and gives us a really educated and well thought out outlook on high frequency trading. I know Dennis and him collaborate a lot on things that are going on. Joe, thanks for taking the time out from your busy schedule this morning to join us. If we don't talk to you, have a great holiday season. Happy New Year, and I'm sure we'll be talking to you again soon.
Hey, Dennis and Joel, thank you very much. You too. Happy holidays.
Okay.
Thanks, Joe.